Hello and welcome. My name is Andy Crook, and I'm your host for tonight's training topic on the subject of never a lender or borrower be. Credit equals cash flow or catastrophe. I'm your host for this training topic on never a lender or borrower be, and my mission is to help garage owners become more successful in business. Today, we're in the financial pillar, and we're getting into something that can make or break your garage: debt. This week, we're talking loans, mortgages, credit cards, overdrafts, and even lending to your own customers. It's a minefield. So let's break it down: the good, the bad, and the kind of borrowing that can quietly creep up and crush your cash flow. We're going to look at 5 different types of borrowing and how they're used typically in a business, and we're going to try and understand the difference between good and bad debt. And that's, I suppose, the key takeaway from today's session. Is I'm not saying that all debt is bad. What I'm saying is there is 2 types of debt, good and bad. And understanding whether or not what you're doing, whether you be a borrower or a lender, is good or bad debt is probably the key to using debt effectively within your business. We're going to cover loans, leverage or liability, mortgages, asset or anchor, credit cards, convenient or crushing, overdrafts, buffer or burden, and lending to customers, generosity or gamble. So without further ado, let's get on with the first of our categories, which is loans and leases. Are they leverage or liability? So business loans or leases can be a brilliant tool if you use them right. Let's give you an example. Let's say you've got the chance to install an MOT bay, but you haven't got the 35 grand or more lying around. If you did have an MOT bay, that could turn another 50, 60,000 pound a year of new business, and therefore a loan is the leverage you need to leap forward to get that MOT bay installed. Now, whether you borrow the money in a traditional loan and you go to your bank and get a loan, or you lease it from a leasing company, there are advantages and disadvantages to both approaches, but you need to speak to a qualified financial advisor or accountant to get the best advice. What I'm talking about is the principle of borrowing the money for an asset that's going to give you a return that is greater than the money you borrowed, because that's what I always class as good debt. So this MOT bay example is a textbook example of good debt. You're investing in the business in tools and equipment that will have a positive return on that investment. So what is the flip side? What's bad debt? In the same situation, you're going to borrow some money to do some work within the business. So bad debt could be borrowing, say, £15,000 to revamp the waiting room. It's going to look great though. Leather chairs, that fancy coffee machine you always wanted. But it doesn't necessarily bring any more customers in. Yes, your customers are going to be in a better position when they're sat there, but does it get them through the door? And I suppose the big difference here is one's an investment and one's an indulgence. Before you plan to borrow any money, model the potential outcomes, run the numbers, and only borrow if the return on investment is greater than the cost, because that way you're investing and not indulging. A great example that I go on about quite a lot was during COVID. Many businesses, and probably most, took up the opportunity of the bounce back loan. And at the time, it seemed like a great opportunity for everyone to paint their garage floor. Now, if you borrowed money and used that money during COVID to paint your garage floor, have you calculated the return on investment? Was it an investment or was it an indulgence? The time to do indulgent things in your business, I would argue, but you need to speak to a financial advisor, someone qualified to give this advice, is when you have made a great surplus in your business, and now's the time to invest some of that money back into the business for reasons of not paying too much capital gains tax, because you're not borrowing the money. It's not a liability. You can then indulge yourself a little bit more in the things that you want to do to your business, but possibly don't bring any more customer or any more revenue. That's loans and leases. Leverage or liability. The same loan can be leverage. The same loan can be a liability. And that's what you've got to do. You've got to do your due diligence. You've got to run those numbers. You've got to understand what it is that you're buying and where it sits in your business and whether or not it's going to bring you any more revenue. Are you going to get a return on that investment? If the return on that investment is greater than the cost, then you are investing. If it's less than, you're indulging. Simple as that. So next, mortgages, asset or anchor. Now, when we talk about mortgages, the goal for many people, the long-term goal for many business owners is to buy the business that you trade out of, because it's equity stability that gives you that leverage. You're in control of your own destiny. And it seems to be, for a lot of people, that's the long-term goal for a lot of business owners. But the question, is it always the right thing to do? And the answer is, I don't know. It depends on the circumstances. Once again, you need to get financial advice. The one thing I will say is if you do already own your own premises outright and you have no mortgage, then hats off to you, because you are in an incredible position if that's the case. If you have a mortgage on your current building, at least you have a greater element of control than if you're renting. But that rent offers flexibility. Should something change in your locality, the council come along and decide to block off the road, and you own the building, and you no longer have access, for example. I know that's an extreme example and unlikely, but these things happen. If you're renting, it's no big deal. If you own it, what's the value of that building now if access is limited? But alternatively, if you bought the workshop 10 years ago and now it's worth double what you paid for it, and instead of all of that rent going down the drain, you've got an appreciating asset, that's like the zenith. That's the ideal outcome for everyone. But what if you're 10 years into your 20-year mortgage and interest rates are now double what they were when you started? Or that there's a big change in your business, the business slows down. That mortgage can quickly turn from freedom into a financial anchor. So, should you buy the buildings you trade from? Then, once again, I urge you to get advice. Do your due diligence and make sure you cover all the angles and look at all the options and make an informed decision. The age-old saying with property is, don't wait to buy property and wait. It's always a long-term strategy that, when executed correctly, should work for most businesses. But you have to do that due diligence. So the third form of borrowing is credit cards. Are they convenient or crushing? Now, credit cards can be very useful, dead handy. You're short of a few £100 for parts, tap the card and crack on. Or your laptop just packed in and now you need a new one. Now you need a new one. Not next month, not next week, not tomorrow, now. But you haven't quite got the cash to do it. So you bang it on the card, don't you? But here's the catch. Miss a payment or just pay the minimum and suddenly you're working for the bank. Most credit cards have extremely high interest rates because they're convenient. They're not meant to be a long-term lending solution. So with credit cards, I always urge the 3 C's: caution, control, and clarity. So if you find yourself using credit cards for unexpected bills, unexpected business expenses, or expected business expenses such as VAT and wages and paying your suppliers, then this is a huge red flag, and I urge caution, because you have a cash flow problem. And this is the lowest level need of any business, and you must fix this first. If you use credit cards for the benefits they provide and clear the balance every month, you're most likely in control of your finances. And they're the 3 C's. So caution, clarity, and control with the credit cards. So if you find yourself using your credit card a bit like a safety net, then you have a cash flow problem. And you need to look into that immediately. Credit cards are not long-term credit solutions. So overdrafts, buffer or burden? Now, I always think of overdrafts a bit like a backup battery. They're there when you need them and invisible when you don't. Great for the odd lean month or if a fleet customer pays late. But the danger is if you start living in your overdraft. it becomes your new normal. Suddenly you're stuck in an overdraft month after month and the fees pile up. The bank gets twitchy and decides to call it in. What do you do now? Now, that is the problem, isn't it? If you get used to staying in the overdraft, often the first thing you need to do if you need to borrow is to pay off the overdraft, otherwise the bank won't lend you the money. Or if you've already borrowed and you're still in your overdraft and the bank calls it in, you can't borrow any more to pay off the overdraft. It's a real sticky situation that can be the undoing of a small business. Overdraft fees can be a very expensive way to borrow money. It's not a bad tool when used correctly, but it's not meant to be a safety net either. If you occasionally need to use your overdraft, it's an indication that cash flow is tight and that you need to take steps to improve the situation. If you regularly use your overdraft, you have a cash flow problem that needs urgent attention. You should work on building your own safety net instead of using your overdraft. The ideal is to build up 3 to 6 months operating expenses in a savings account. So that gives you that buffer then instead of using the overdraft. You don't want in a savings account much more than 6 months operating expenses because that money is actually going down in value. If you want to learn a bit more about that, look on the training talk I did on money and where I talk about how inflation is effectively eating your savings. But you do need some. Or you're going to use your overdraft if you get that unexpected bill or that unexpected late payment. Whatever it is that causes your cash flow to go slightly wonky 1 month. And it's all right if you're using it very occasionally. But if you're living in there, you've got a problem and you need to sort it out because it is an extremely expensive way to borrow money. So finally, we're going to come on to the last of the subjects in the Never a Lender or Borrow Be training topic. And this one's a bit more contentious. Lending to customers, generosity or gamble. So when it comes to lending to your customers, there are 2 types of debt. There is unauthorized debt, which is any invoices that are past due. If you have customers that regularly pay late, then you need to renegotiate any terms you have with them. Reduce the 90 days to 30 days. And if they're already on a 30-day and they're still not doing it, then reduce the 30 days to payment on collection. Start to be more disciplined with collecting your invoices because that's your unauthorized debt. If you're a member of the Federation of Small Business, they've got some great tools and resources on collecting unpaid debts, letters and templates, and some interesting articles that you can look up about how much late payments cost small businesses. So I don't like to call them late payments. I call them unauthorized debt. Then you have authorized debt. And these are your service plans or your interest-free credit. And it's a good idea on paper because it helps customers budget, make big bills become more palatable, and done right, it can build loyalty and trust. But in my opinion, here's the pitfall. You're not a bank, you're a garage. And it's not these things are terrible because I think this is a tricky one. And in my personal opinion is, are you in danger of attracting the wrong type of customer? Because if they're the right type of customer and they can truly afford your services and run the car that they bought, when they're coming to you for that credit, is it because you're the last option and are they going to be that credit worthy? If they're planning ahead and budgeting, slightly different, but surely does that answer the question, if they're coming to you for that, what is the state of their finances like in the rest of their life? I'm not judging anyone, but it would appear to me that if you're doing that, can you possibly afford to run the car? But the question is, in Formula One terms, do you want subprime customers? Could the effort you're making in the marketing, in attracting customers to go on to service plans, be better spent attracting better customers that if they're hit with that unexpected bill and they're credit worthy, will have the means to arrange credit for themselves? They'll just get their credit card out and pay it. Or they'll go into their savings because they've got their saving buffer and they'll pay it out of that. In my experience, and I've been on both sides of this coin in a previous employment, service plans are well suited to the dealers. And why? It ties the owner of the new vehicle in on a payment plan that's often added to their payments for the warranty period, and it retains that customer during that period for the dealership. And during the warranty period, that customer is less likely to be faced with a large unexpected bill because the chances are the warranty is going to cover it. And if you're on a service plan, the chances are you've had your car serviced along with the terms of that warranty at the manufacturer. There's no quibbles. It's all taken care of. When you leave the safety net of the dealer network and you're on a service plan, and your service plan covers you for some unexpected bills, but you suddenly get a much larger bill, you think your motoring costs are being covered, and you turn up at the garage and you've got an additional bill on top of what you've put into your service plan. How is that customer going to react? How are you going to deal with that? If they're already on the limit of everything in terms of their borrowing, how are you going to proceed with that job? Is it potentially a problem for you, or are they a solution for you? I don't offer them, so I can't really answer that. But it's a question I think you ought to ask yourself before you get into offering that stuff. Just because it works for the dealers, they're working on a slightly different type of vehicle, slightly different age profile, might work differently. So ultimately, the question comes, why don't they just buy a newer car with those payments? I don't know. It's something for you to discuss. So my final thoughts, the difference between debt and disaster. What's this week's takeaway? I suppose the first thing we ought to remind ourselves is that not all debt is bad. In fact, good debt can be a launchpad, add leverage, and provide legacy. It can help you scale, succeed, and secure your future. But when borrowing becomes your backstop, that's bad debt. So here's how I like to frame it, and maybe this will help it stick with you. Good debt is planned, purposeful, and profitable. Bad debt is unplanned, pointless, and unprofitable. Just like I said at the start, credit can either equal cash flow or catastrophe. So next time you're about to borrow or even offer a customer credit, ask yourself, is this a step forward? Or are you just postponing the pain? Be the lender with limits, not the lender with liabilities. And most of all, if you do have bad debt in your business, have a plan to eradicate it and start with the most expensive debt first. If I made you think about debt within your business, then I've done my job. Remember, if you should, you must, and what's stopping you is starting. Back to it then.